Hello again, this is John Boyd with the Home Buyers Agent. Today we're going to discuss two great mortgage options in Michigan right now. If you stay with me to the end, I'll let you know a couple of solid, credible lenders who can get you these great deals. For background, our office is the only buyer's real estate company in the area. We chose to work exclusively with buyers to avoid the obvious conflicts of interest that traditional real estate companies have. That means we can offer additional services to home buyers too. One of those services is that we've been helping home buyers shop for and negotiate mortgages for over 35 years. However, we've never made a penny of profit on mortgages because, unlike many real estate companies, we aren't trying to generate extra income by pushing you to an affiliated mortgage company. During the process of going back and forth with lenders, we often encounter outstanding deals from some lenders. And it's essential to recognize that no single lender always offers the best loan option for you as a buyer because different buyers have different needs. Now, with that out of the way, let me tell you about two great loan deals available to home buyers right now in Michigan. First deal focuses on larger loans for $1 million type homes. These loans for these high value homes are somewhat unique and therefore don't follow the standardized guidelines for what we in the industry refer to as conforming loans. The limit for a standard or conforming loan today in Michigan is $806,500. Home loans for amounts larger than that are referred to as jumbo loans and usually come with higher interest rates. How much higher? Well, it depends on the lender and the market when comparing, but often jumbo pricing is 0.3% higher than conforming loan pricing. That makes a huge difference on large loans like this. For example, on a $1 million loan, a 0.3% difference is worth about $15,000 on the day of closing for a 30-year fixed rate loan. So here's where the deal comes in. One credible local lender is offering to do a $1 million loan as two loans. The first one is the conforming loan amount, $806,500. Then they give you a second loan for $193,500, the difference. That second loan is at the same interest rate as the first loan. That's where it gets really good. Now, it gets even better for some buyers. If you're buying a $1 million home, you have solid assets and excellent credit, you may be able to use this deal to put down just 10% and still avoid paying any private mortgage insurance. Private mortgage insurance could cost a buyer about $400 a month on a loan of this size. So simply by optimizing the loan, a buyer like you could save $15,000 at the day of closing and then about $400 per month for a couple of years while you're getting rid of the private mortgage insurance. They call their loan the Jumbo Crusher. It sounds like a great deal for people who would normally need to use a jumbo loan for their home purchase. If this is your first time on the channel and you want to know some great home buying tips for the Michigan home buyers, subscribe below. The second loan deal is getting one of our Ann Arbor area buyers a 6% interest rate with no points on a 30-year fixed rate loan right now. Today, the average interest rate is about 6.75%. So if you're using, say, a $400,000 mortgage to buy a house, this deal could save you about 0.75% on your interest rate, which is worth roughly $12,000 at closing. This program is strictly limited to Michigan home buyers. The specific limitations vary depending on where in Michigan the home is, but in the Ann Arbor area, if you're looking to buy a home priced under $544,233, and your total household income is less than $151,080 for one or two occupants, or your household income is less than $176,260 if there are three or more living in your home, it can potentially work for you. The loan is offered as part of the Michigan State Housing Development Authority program, and that's sometimes referred to as MSHDA. This option just became available recently, and like I said, there are some other limitations and a couple of extra hurdles to jump over, but it's a great option for a lot of home buyers. When we are working with you to buy a home, we'll connect with lenders like this and make comparisons to find the best mortgage options for you. If you want to dig in personally, here's where you can get more information on these two deals. For the Jumbo Crusher loan, we suggest you contact Carrie Ashleman. She works out of the Independent Bank office located on Boardwalk here in Ann Arbor. For the MSHDA 30-year fixed rate loan at 6%, you might talk to Mark Coplin with Stoughton Financial. You can connect with him at his website at mylendermark.com. Carrie Ashleman, who has that jumbo loan I mentioned, also has done some of these terrific MSHDA loan deals recently, so you could give her a call also. Let me take a minute to discuss comparing loan deals and what we mean when we say savings at closing, or savings on the day of closing. Lenders generate profit from three sources: the interest rate itself, origination fees they charge to put a loan together, and points you might pay to get the lower interest rate. A point, which is 1% of the loan amount, is money you pay that goes to the lender at closing. You should be aware of all these factors when you're selecting a loan deal. For this overview, I'm just going to talk about the interest rate and the points. For the last 40 years or so, lenders have offered homebuyers the ability to pay points to lower their interest rate. Here's an example from a loan estimate form for a $150,000 loan. This is the second page, and you can see this buyer will be paying 1.875% in buy-down points and a $1,500 origination fee. This is a significant amount for a $150,000 loan. So here's where we can compare the effect of paying points on the interest rate. Here's an example using a $100,000 loan to make the numbers easier. However, the same idea applies to any loan amount. And these are generic examples to illustrate the proposal from a lender. Let's say you are offered loan 1 here. The interest rate is 7%. You are ready to move forward, but the loan officer asks if you want to save some money. Then they offer loan number 2, and all you need to do is pay them 1 point, which in this case is $1,000 at closing, and you'll get a 6.75% interest rate. They point you to the bottom line titled Total Interest, which is the amount of interest you would pay if you kept this loan in place for 30 years. Comparing the total interest between loan 1 and loan 2, you would save over $6,000 just for paying an extra 1% or $1,000 at closing. Sounds like a good deal, right? Spend $1,000 to save $6,000. The fallacy here is that the lender knows most homebuyers only keep their loan in place for about 5 to 7 years. If you sell, refinance, or pay off the loan, they get their money back to loan out again, and your buy-down points go up in a puff of smoke, or you could say, it goes back into the lender's pocket as profit. If we go back to our loan example and look at the difference in monthly payment between loan 1 and loan 2, you'll see it's about $17 a month. From a financial standpoint, we want to know when you reach the break-even point on the $1,000 you paid. And as it turns out, $1,000 divided by the $17 difference each month equals about 60 months. This is how the lender is pricing the loan. This is how exclusive buyer agents and others with a background in finance view the loan pricing. Now, suppose two lenders have approximately the same origination fees, and lender A is offering a 6.75% loan with 0 buy-down points, while lender B is offering the same loan with 1 point buy-down. In that case, we can say that lender A deal will save you $1,000 at closing compared to lender B's deal. It isn't the $6,000 you might save if you keep the loan for 30 years. It is a real-world figure based on real loan pricing and your monthly payments over 5 years. Now here is the actual spreadsheet we use sometimes, which examines the loan rate, the origination fees, the buy-down points, and calculates the total lender-controlled costs over the first 5 years of the loan in the far right column. Is how we compare the figures to determine savings at closing.